Okay, good afternoon and welcome back everyone to our Options and Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're here to continue a conversation that we had started about 4 weeks ago regarding volatility, implied volatility, and taking a deeper dive into volatility to give us a better sense for not only what is it, how do we measure it, but more importantly, how do we use it for our trading? Why is it relevant for options traders? So I want to break down volatility. Now, this is one of the tougher topics, in my opinion, to teach. It's also one of the tougher topics to understand, which is why today's approach is going to be predominantly a lot of examples, real examples of the real stocks, showing you different volatilities to give you a better understanding as to how to interpret volatility, to give you a sense for how you can incorporate it into your trading. Now, this is a bit of a more advanced topic. So for those of you that are brand new to OptionsPlay, if you find this a little difficult to catch up or stay with us, we do have an introductory course on volatility from 4 weeks ago. I do recommend that you take a look at that on YouTube. Very important topic, in my opinion, for most options traders, because it is at the fundamental core at how do you select what strategies to trade, how do you select your expiration dates and strike prices. And also, there are so many different forms of volatility that many times they get bucketed under the same bucket of volatility. But today I want to make sure that everyone understands what the different forms of volatility are. Even within implied volatility, there are lots of different ways to measure implied volatility. So it's important that you understand how they're measured so that you're understanding and making sure that you're using it correctly. You don't want to just consider implied volatility as a single metric that you can use. There are many, many different forms of implied volatility. So it's important to understand their differences. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So what we'll start off with is continuing our discussion that we had last time, which is the difference between historical versus implied volatility. And today what we're going to do is we're going to spend most of our time looking at implied volatility, talking about what it is and how you're going to use it. In order to understand that, I'm going to first break down intrinsic versus extrinsic value of an option, because the extrinsic value of the option is really the volatility piece that we're focusing on. We want to understand how much extrinsic value are we either purchasing or selling on an option, because that's heavily dependent, because that is the data point that gives us an understanding as to whether perhaps we would prefer to be buying that option or selling that option. So extrinsic value is an important thing to understand. More importantly, how do we measure extrinsic value through implied volatility that gives us the data points that we need for our trading? Then I want to take a look at how should we interpret volatility. Again, to do so, I think the best way to do it is by going through a lot of different examples of different stocks, different expiration dates, different strike prices, show you the different implied volatility so you have a better sense for how implied volatility is expressed to give you the data that you need. And then, like I said, there are so many different forms of implied volatility. I want to talk through some of the more common implied volatility metrics, what they actually mean so that you are using it correctly, and understand what limitations they each have so that you don't overestimate volatility or have overconfidence in a few volatility indicators if you understand how they're actually calculated. And lastly, like I said, probably more importantly, is really looking at trade selection and option Greeks. So how does implied volatility help us calculate what expiration date, what strike price are optimal for the strategies that we want to trade? And lastly, at the very end, I will try to go through a few different examples and open this up for Q&A at the very end. So my name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. I want to share with you some of the insights that I have as a result of building OptionsPlay and the different implied volatility metrics that traders use to help them inform their decisions. That's what I hopefully help you guys walk away here today. So on the first introduction to volatility webinar, we introduced the difference between historical versus implied volatility. So I'm just going to do a quick summary. Historical volatility is the average deviation from the average price in a given period. So basically looking at history and looking at how much variation a stock has around an average price. Is it very volatile around the average price, or is it fairly small averages around the average price? So does a stock historically move a whole lot, or does it move a little bit? So historical volatility lets us know in past history what the movement is. Now, we always expressed historical volatility in the form of an annualized standard deviation. So, and the reason that we use annualized standard deviation is so that we're always comparing apples to apples. We always want to annualize numbers so that we can quickly compare a stock over the past 30 days versus the past stock versus the past 60 days. If we express them in annualized terms, we will be able to compare different metrics, apples to apples. And this is a theme that we're going to talk about a lot here today, is the standardization of implied volatility, so that regardless of whether we're looking at different price stocks, different expiration dates, different strike price, that we have one metric that we can go back to and compare one versus another. Because if you're looking at the 30-day volatility versus the 60-day volatility somewhere else, you can't really compare those two numbers side by side. It's not a fair comparison. So a lot of the things that we're going to talk about here today is how do we standardize the view of volatility so that we can easily compare the volatility from today versus the volatility from tomorrow, or the volatility of a $30 stock versus the volatility of a $100 stock. It's all about standardization. So today what we really want to talk about is how do we standardize volatility? What are some of the best practices to do so? What are some limitations of doing so that you have a better understanding of volatility? Now, the second volatility that we talk about is implied volatility. This is the one that we're going to spend most of our time here today. So we talked about historical volatility is what has happened in the past. Implied volatility is what is the option market telling us that is likely going to happen in the future, or the expected volatility in the future. So implied volatility takes into account what is coming up in the future. So let's say if there's an earnings event coming up, if there is some kind of macro event coming up, if there's something else that affects either the asset's potential future volatility, that's how we measure that using implied volatility, which is the market's anticipated future volatility given all known information. So the anticipated future volatility given all the known information. This is the one that's going to be most useful for traders. Historical volatility gives us a better sense for what's happened in history, but implied volatility is what we're actually trading when we're buying and selling an option, because an option is simply an expression of the expected future movements of a stock, which includes volatility. So the important thing to really remember is the fact that most traders consider implied volatility as mean reverting. What that means is that over time, it will return to its historical average. So we're going to talk about this in a little bit, because this is the fundamental thesis behind why we should pay attention to implied volatility, to give us a better sense as to perhaps whether we should be buying an option versus selling an option. So it's important to understand that implied volatility is mean reverting, meaning that implied volatility will move higher and lower, but it will always converge back to its mean value at the average. So what we're doing here is, to better understand this, is first breaking down how an option is actually priced. So if you have a stock that's trading at $25 and you're looking at a $20 call option, this call option, because it is below the strike price, has an intrinsic value already of $5. Because if I exercise this call today and I can buy the stock for $20 and immediately sell it for $25, that has an intrinsic value of $5. That is something that cannot change regardless of what the future expected value of that option is, or the future expected volatility of the stock is going to be. However, there's a second component of each option price, and that's extrinsic value. The extrinsic value is the part that expresses what the future expected volatility of that stock is going to be. The higher the future expected volatility, the higher the extrinsic value. The lower the future expected volatility, the lower the extrinsic value. Now, the important part here to remember here is that when you have intrinsic value, intrinsic value will never erode because you can always buy the stock for $20 and immediately sell the stock for $25. No matter what happens, that will always be true. So this part will never ever change, the $5 intrinsic value, as long as the stock stays at $25. But the extrinsic value will change because the extrinsic value will erode to zero at expiration. So at all options at expiration have zero extrinsic value. So why is this important? Because if you're a buyer, that means that as an options trader, you're going to lose $2 of the call option that you purchase to extrinsic value. So what that means is that you must believe that the stock's going to make a big enough move to overcome the $2 loss that you know you're going to experience as a buyer of this option. On the flip side, if you're a seller of this option, you know the $2 extrinsic value is what you're going to capture if you hold this call option to expiration. But as a seller, you also have risk for doing so. But as a trader, what you're always trying to figure out is the market either overpricing or underpricing volatility? Because if the market's overpricing volatility, what you want to do is you want to be a seller. If you think markets are underpricing volatility, what you want to do is be a buyer, okay? So this is really where this requires an understanding of option pricing so that you have a better understanding as to which side of the equation you want to be on. However, the problem here is that I might be able to remember that $2 for of an extrinsic value for a a $25 stock when the strike price is $20, and maybe in this particular case I have, let's say, 2 months left to expiration. I might remember that $2 of extrinsic value is relatively cheap. But what if the stock climbs from $25 to $36? How do I know whether, what the extrinsic value at that point is cheap or expensive? And what you start to realize is that it's very difficult to remember or know whether a call is cheap or expensive. And that's really where we turn to implied volatility. Because when we're looking at just the call options themselves, there's so many other factors that go into determining whether this call option is cheap or expensive. You have the stock price, you have the strike price, you have the days to expiration, you have lots of other things that you have to figure out before you can determine whether something's cheap or expensive. And that's why we turn to implied volatility, because implied volatility, what it does is it simplifies our view of what the expected future volatility is into a single metric. And when we have a single metric, it becomes easier to better understand whether it's cheap or expensive. So today what we're going to do is we're going to go through some exercises to show you how we measure implied volatility, how we determine whether an option is cheap or expensive, and then from there, how do we then use implied volatility to help us select expiration dates and strike prices, okay? So we've already talked about why we sort of need to understand implied volatility. It's so that we understand when to buy volatility when it's cheap and sell volatility when it's expensive. But how do we determine if volatility is actually cheap or expensive, right? We all know the term cheap or expensive, right? But how do we know that $2 is cheap or expensive? How do we know that it shouldn't be $3 or $5 or $7? There really isn't a good way by looking at this to quickly understand whether something's cheap or expensive. And that's why we turn to implied volatility. And some of the challenges is that if you didn't have implied volatility, you'd have to think about the different stock prices. You have to think about different expiration dates, different strike prices. There are all these factors that come into determining the implied volatility in options. So what we want to do is we want to show you how the market views implied volatility, or how it views the future expected volatility, to give you a better sense for how we're going to use this metric. So here I have an option chain for BMO. This is the October options chain. Now, as you can see here, BMO is somewhere between $78 and $79 as marked by the line on the option chain that tells us where the current price of the option is. And what you have are two columns. You have implied volatility for calls on the left-hand side, and you have implied volatility for puts on the right-hand side. And what you can see here is that depending on which strike price you choose, the implied volatility is runs a pretty wide range, right? So here you have, let's say the $72 call option, which is currently trading at about 34% implied volatility, versus let's say the 82 call option that's trading at about 20% implied volatility. So we're talking about implied volatilities that are pretty different from each other depending on which strike price that we're choosing. Now, if we also look at the put side, notice how the puts are also quite different as well. If I have a, let's say, an $82 put option, this is looking at a 22% vol versus a $72 put option is looking at a 31% vol. So as you can see, there's lots of different volatilities here, right? There's different, you have calls versus puts, you have strike prices, you also have expiration dates. So far, we're only looking at the October expiration dates. So as you can quickly see, there are a lot of different implied volatilities. So today what we wanted to do is give you a better understanding as to what these all mean. And conversely, if we look at the October option chain, this is the same BMO option chain, but for for November expiration. Let's do the same call option. Notice how here the $82 call options are 20% vol, 72 call options are 29% vol. 72 puts are 30% vol, and the 82 puts are 24% vol. So you have vol numbers all over the place, and it becomes sometimes difficult to understand as to how to use it. So the first thing we want to do is actually back up and ask ourselves, when we say that the $72 strike price has an implied volatility of 29.29%, what does that actually mean? What does that mean, 29% implied vol? So let's take a step back to what we learned a few weeks ago, which is how do you interpret implied volatility? So for this, we're going to use a simple option, a simple example to give you a better understanding. Why do we want to know implied volatility expressed in an annualized term? Because when we look at implied volatility on option chain, so when we tell you that the $78 call option has an implied volatility of 26.88, what that always is an expression of is the annualized implied volatility. So we want to take a look at what does the annualized implied volatility actually tell us. So what we can do is we can use the stock price, the annualized implied volatility, to calculate the implied standard deviation of that stock. And what this tells us is the expected range that the stock will be in the next year between these two prices. So what we do is we take the stock price, multiply it by the implied volatility. So if we took a $50 stock, multiply it by 20%, if the implied volatility of the option is 20%, what that means is that this stock will have a 68% chance of moving either higher by $10, so up to the $60 range, or to the $40 range, to the downside, a $10 move to each side, because 50 divided times 20% is $10 to each side. So this gives us a better understanding as to what is the probability of the stock being in between certain prices. So when we see that the implied volatility is 20%, that means there's a 68% chance that this stock will be between $40 and $60 exactly 1 year from today. There's going to be a 16% chance that the stock will be below 40, or a 16% chance that the stock will be above 60. So that's how we use implied volatility. But what you quickly realize here is that when we're trading, it's not really useful to know where is the stock going to be 1 year from today, because likely we're trading an expiration that only expires maybe 30 days from today or 60 days away. So what you really want to know is what is the expected range over the next 30 days or 60 days, or the time period that's specific to what you're trading. And that's really one of the things that we want to talk about here today is how do we take that implied volatility number that is a standardized number that makes it easy for us to compare apples to apples, and then how do we then use it for our own trading? So here's an example of National Bank, right? So before we looked at BMO, we looked at BMO October options, we looked at BMO November options. Now let's take a look at National Bank October options. So National Bank here was trading somewhere between $66 and $68. That's the at the money strike price here for October. at the at-the-money strike for a national bank. And as you can see, the at-the-money options are trading at around 24 vol. The out-of-the-money options are trading at 20 vol. As you can see, these are very similar to what we saw before in BMO. They're a little bit more elevated than what we saw in BMO, but they're largely the same. And we would expect that a stock like BMO and National Bank to be reasonably similar when it comes to implied volatility. And when we look at the November options, we see the same thing. However, when we're looking at the November options, what we notice here is that the November options trade at a slightly higher implied volatility. Now, the call options were actually a little cheaper, but the put options were a little bit more expensive. And what you quickly realize is that it's almost impossible to stay on top of all these different calls and puts, all the different expiration dates, strike prices, to determine whether something's cheap or expensive. You know, how do I determine what the expected range for October is? How do I determine what the expected range for November is? Because if I'm trading October, I care about the October range. If I'm trading November, I care about the November range. So this is really where the complexity of implied volatility or volatility in general comes into play. And that's why I think it's so important to have a better understanding of what the different implied volatility metrics are, to give you a better understanding as to how traders summarize this information to give us a better understanding as to whether truly an option is cheap or expensive, because it's impossible to get a sense for which options, you know, between BMO or National Bank, whether we should trade the Octobers or Novembers, which one's cheaper, you know, are calls cheaper, or puts cheaper, are in the money options cheaper or more expensive? There are so many of these types of questions. So this is really where we turn into some of the implied volatility metrics. But before I move on, I just want to show you the difference between something like a National Bank and BMO versus an option chain like Weed. So here is the implied volatility for Weed going out to October. And notice how the at-the-money call options are trading at a 63% volatility. The out-of-the-monies are trading at 56% implied volatility on the call side. The put side, even more expensive, 75% implied volatility for the at the money puts, 67% implied volatility for the in the money puts. So puts in this particular case more expensive than calls. But this takes a long time to really understand this stuff, and being able to be comfortable and understand, you know, where is Weed options currently today versus where it was a week ago, right? You know, is 63% volatility for an at the money call option, is that cheap or is that expensive? You know, was it 65 last week? Was it 80 last week? Was it 30 last week? These are all the things that we need to know, but it's impossible to track these things in your head. And that's why options traders turn to implied volatility metrics to give us a better understanding as to whether an option is cheap or expensive. So what I want to do is break down and be clear. When we talk about implied volatility, there's a lot of different forms of implied volatility. So I'm going to talk about 3 of the most popular uses of implied volatility that you'll generally hear traders use. And I want to make sure that everyone understands the differences of each one, how they're actually calculated, so that you also have a better understanding as to what limitations they have, because each one has certain limitations. Each one has their pros, each one has their cons. It's really important to understand what each one means so that you have a better understanding as to what the pros and cons are. So when we talk about individual strike prices, those are specifically, each strike price has its own calculations of implied volatility, because each strike price has its own intrinsic and extrinsic value. As we said, intrinsic value is something that cannot be changed. Extrinsic value is something that changes with the market's expectation of future volatility. The more the market expects future volatility to be, the more expensive that extrinsic value is. The less the market expects the future implied volatility to be, the smaller the extrinsic value of an option will be. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you, that the expected future volatility of a stock is directly correlated to the extrinsic value of an option. So when we look at individual strike prices, what we're doing is we're calculating the extrinsic value of each option and then backing out what does that tell us in terms of what is the market telling us? What is the future expected volatility? But it gives it to us in a form that's annualized so that we can quickly compare the 60 strike versus the 64 strike versus the 68 strike versus the 72 strike. And what you can see here is you go further out of the money, the implied volatility is actually cheaper. Now, this is not particularly common. We generally see that further out of the money options have actually higher implied volatility. But what this tells us is that the further out of the money options in this particular case are actually cheaper from an extrinsic value perspective. If we look at put options, as you can see, this is more normal in my opinion, because as you go further and further out of the money, these are puts, so as they go lower, they become further and further out of the money. As you can see, you get higher and higher volatilities. So what the limitations of individual strike prices is that it only tells you the implied volatility of that one strike price. And if you look at just one strike price and you don't look at all of them, you might miss a good idea of the picture here, because as you can see, the range is pretty large depending on which strike price that you choose. So these are useful in helping you select individual strike price. And we're actually going to come back to this in a few minutes as to how implied volatility can help us select strike prices. But when you're looking at individual strike prices, be careful, because you're just looking at the strike price of that one option. You might be missing the big picture here of all the options. So individual strike price is very powerful to help you, give you a better understanding of the specific option that perhaps you're interested in trading. But keep in mind that when you're trying to determine whether something's cheap or expensive, you might want to look at it from a more holistic perspective. And that's really where implied volatility or summary implied volatility indicators come into play. The most famous summary implied volatility indicator is probably the VIX. How many of you are familiar with the VIX? Please type 2 into the chat window if you're familiar with what the VIX is. The VIX is a measurement of 30-day implied volatility of the S&P 500 options. What it does is it takes a look at the whole chain. Not only does it take a look at each individual strike, what it does is it takes a look at all the strike prices. And what it does is it has a way to average up the prices. And what it does is it basically assigns the most weight to the at the money strike prices. And the further you go out of the money, the less weight they have to the VIX. So the biggest weightings are always given to the at the money strike prices. So for example, on this particular option chain, which I'm not, it doesn't really matter what it is. As you can see, the at the monies are somewhere in the 22 to 28 range. So these would have the highest weights. And as you go further out of the money, they have lower weights. And that is what an implied volatility summary is meant to give you an idea for. It's just that because each individual option has volatility sometimes all over the place, what a summarized implied volatility tries to do is it summarizes all the strike prices to give you an average number, so that instead of saying, okay, what is the S&P 500's 30-day at the money strike price implied volatility is, it gives you an average of all the 30-day implied volatilities. Now, some of the more common indicators on this front are sometimes you get a IV30 call, an IV30 put. That means that you're only taking the averages of just the calls or just the averages of just the puts. And then you also have IV30 average, which is what the VIX is technically. It's an IV30 average. And what this does is it always gives you a continuous 30-day look at what the 30-day expected volatility is. So you always have a constant time frame, and this is still expressed in annualized terms. But what we're looking at is we're only looking at 30-day options to give us that sense for where the projection is going out 1 year. And this is useful in a few different use cases. Now, when you just look at IV call 30 or IV call put IV30 put or IV30 average, which is like the VIX, like I said, the number in itself certainly gives you a sense for whether volatility is increasing or decreasing. However, what it doesn't really give you a good sense for is whether it's cheap or expensive. And that's really why most places will turn to a metric called implied volatility rank or percentile. What the implied volatility rank or percentile does is it says that basically, if you were to track the IV30 average, you would have a line chart that looks like this. Now, in order for you to say, okay, if let's say the current reading, let's just say the current reading is 26%. In order for you to know whether 26% is cheap or expensive, right? So even if you had that number, you would only know if it's cheap or expensive if you knew what the IV was over the past year, right? So unless you were the type of person that tracked what the day-to-day implied volatilities were, you would really have a tough time gauging whether, for example, if let's say I told you that the average calls right now are roughly at about 23%, right? The average implied volatility of this call of this October at the money call option is 23%. You still wouldn't know whether 23% is high or low unless you constantly throughout the year kept track of this stock and knew that, you know, on the higher end is traded as high as 50, on the lower end is traded as low as 12 or 13. So 23 is kind of on average, kind of somewhere in between. But that means that you must have had a good understanding of tracking the historical implied volatilities. And guess what? That's not always easy to do. It's not like tracking the historical stock price, right? So for example, how do you know if a stock is cheap or expensive? You would bring up a chart of the stock and you would see where does that stock trade in comparison to its history. You might use a valuation metric like PE ratio and see where's the current PE ratio compared to history. Well, you would do the same thing for implied volatility. And what we do is we use something like an IV30 average. So we take the average of the 30-day implied volatilities, and what we do is we track it for the past year. And we basically say, how far has the implied volatility 30 of this particular stock, where has it traded within the last year? Now, for those of you that have tracked the March sell-off, most volatility indicators will look something like this. And what we do is we say, instead of saying that the current implied volatility is let's say 26%, what we do is 26% doesn't really matter because some stocks have really high volatility, some stocks have really low volatility. Just knowing that the implied volatility of 26% isn't particularly useful. What I want to know instead is what's the high in this particular case? Let's say that high was 85. What's the low for the whole year? And let's say that particular level is, let's say it was 12. And what I really want to know is just where's the current reading of 26 within this range? Because just like the same way I look at a stock history and I look at, you know, where is the stock trading in relation to its past year's range? You can do the same thing for volatility. Say, what was the high? What was the low? And where are we currently trading within that? So in this particular case, I might find that, and what IV rank and IV percentile looks at is instead of looking at 12 and 85, which are just completely arbitrary numbers, what it assigns is a 100 to the top of the range and a 0 at the bottom of the range. So if let's say over the next few days, this stock's volatility drops to 12, instead of knowing that the implied volatility is 12, I'd much rather know that the IV rank or the IV percentile was 0, meaning this is at the lowest point this implied volatility of this stock has ever been in the past year. That's a much more easier metric to understand. Of 0 to 100, everyone can understand 0 to 100. 0 is the very bottom, 100 is the very top, right? Otherwise, I would have to remember where the top is. I'd have to remember that this stock peaked at $85 or 85 vol, it bottomed at 12 vol, and I have to know roughly where the current vol is in order to do that. And that's why implied volatility rank and percentile are heavily used by many traders to gauge whether an option is cheap or expensive. As you approach anything above 50, it is considered very expensive. Anything below 30 is considered on the cheaper side. But this is all determined to give you a better understanding of cheap or expensive. Now, the reason I brought this up is the fact that it's important to understand how these are actually calculated. And the important thing to remember here is that what you're doing is you're first looking at the average 30-day volatilities and plotting the historicals. Now, this is very useful if you are also trading a 30-day option, because then you can compare what you're trading versus historical highs and lows. But if, let's say, you're trading instead of a 30-day option, sometimes you might be trading a longer dated option. Maybe you're trading a 6-month option instead. And this is really where it's important to understand what limitations these these metrics have, because this is only measuring the average implied volatility over 30 days over the past year. But if, let's say, you're trading a 6-month option, guess what? You can't compare a 6-month implied volatility to the average over the past year of the 30-day options, because those aren't fair comparisons. You're trading a 180-day option, a 6-month option. Whoops. You're trading a 180-day option, but the IV rank is based on a 30-day implied volatility. Are the two correlated? Yes, they are going to be correlated, but as you can see in many option chains, if you look at the implied volatility of a 30-day option versus the implied volatility of a 180-day option, they could be drastically different from each other, because the 180-day option probably incorporates 2 earnings event built into it, while your 30-day option may have no earnings event built into it. And those 2 things will have very different implied volatilities. So that's why it's so important, from my perspective, to make sure everyone understands how these metrics are actually calculated, because if you just simply use them as, oh, IV rank 0 means that it must be cheap, you might be doing yourself a little bit of disservice by not knowing how they're actually calculated. Most IV rank and percentile, which is very useful for most traders to know, okay, where is it currently sitting on a scale of 0 to 100, right? 0 to 100 is really easy to understand, but understand that the 0 to 100 is only for the 30-day option. So if you're trading a 20-day option, a 30-day option, a 45-day option, is this metric good enough? It usually is. But if you're trading something that's drastically different, if you're trading something that's not a 30-day option, if you're trading a 90-day option or a 180-day option, understand that these types of metrics may not be an accurate summation of the type of option that you are trading. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. So, like I said, these are a lot of things that I'm going over here today. So I will open this up for Q&A, because I know there's going to be a lot of questions. But let me get through this so that I can show you some examples of how to use this. So just to back up real quick, many times investors, what they'll do is they'll say, when volatility, such as especially when you look at rank or percentile, something like this, that ranks how the current volatility is compared to its last year high and last year low, many times investors will say, if it's above 50, then it's time to be selling volatility, whether you're selling cover calls, selling credit spreads, selling iron condors. This is where the extrinsic value of an option is fairly rich, and you know that there's a high, that what you're selling, you're going to have more in terms of time decay over the life cycle than when volatility is cheap. When volatility is between 30 and 50 percentile rank or percentile, this is usually where it's elevated but not extreme. Anything below 30 is normal. Anything below 10 is extremely cheap. Those are the general levels that most traders would generally pay attention to. So option sellers, many times they'll scan for IV ranks or percentiles that look like this. Buyers will usually scan for IV ranks that look like that. And then anything in the middle means that implied volatility, meaning the options aren't particularly cheap or particularly expensive, that you probably want to focus more on just the pure directional view. That's going to play a much bigger role in the P&L of your trade. So this is how traders will typically try to scan for symbols to give us a better understanding as to which symbols have really expensive options right now, and those are maybe ones that you want to focus on if you're selling. Which symbols have really cheap options, so if you're trying to buy premium, that might be the types of symbols that you want to focus into. And that's really how traders generally use these types of implied volatility metrics. Now, another way to look at it is really looking at the implied volatility across the different expiration dates. So many times you might find in this particular case, we don't have a lot of variation here from expiration to expiration. So if we look at the calls, here is probably somewhere in the 17 to 18 range. Here you're looking at the 22 range. Here you're looking at the 22 range. Here you're looking at back into the 20 range. So as you can see, there's a pretty decent diverse, I would say, implied volatility depending on the expiration date that you're buying or selling. So as you can see, 17 on the front month, 21 on November's, maybe 22s in the December's, and then January gets down to the 20s. So traders will sometimes use this to give us a better understanding as to if we're selecting expiration dates. And maybe when you're selecting weekly options, you might see more sensitivity to it. But generally speaking, if you're buying options, you obviously want to buy lower implied volatility. So you might want to buy a January. If you're selling, you might want to sell a higher, like a November or December. This just gives you a better sense for when you're selling or buying and you're choosing expiration dates, whether you're buying or selling an expiration date that has generally relatively cheaper or relatively more expensive options. Now, usually these things are dictated based on things like earnings, right? So my bet, if I'm looking at this option chain without knowing what stock it is, without knowing anything else about this stock, my guess is that there is an earnings after October 16th and before November 20th. And that explains why there's such a big jump from those October to November options. Now, a lot of stocks are reporting earnings after November 16th, so this makes some sense. And that's why you notice that the December and January options are all significantly more expensive than the October implied volatilities, because the November, December, and January expiration dates all encompass this next earnings cycle that's built into it. And the October one does not, because this stock probably reports earnings after that October expiration date. So this is really how expiration date selection sometimes can be influenced based on your views of implied volatility. But it's really important to understand what parts of implied volatility should you focus on. Here in this particular case, you're focused more on the implied volatility of individual strike prices within an expiration date. There are other times when you're selecting symbols that you want to be focused more on the implied volatility of the whole option chain. There's many different ways to use this, and this is just meant to give you a better understanding as to how traders typically look at this. So next, what I really want to talk a little bit about is selecting strike prices, because implied volatility is actually extremely critical in helping you select the appropriate strike prices depending on whether you're buying versus selling options. And this has to do a little bit with calculating Greeks. We're not going to get into the calculation of Greeks. We're going to talk about the outcome of the Greeks and how they're being utilized to help you select the optimal strike price for your option strategy. So one of the ways that we use implied volatility is we use it to determine the one standard deviation move. And what we do is we take the stock price multiplied by the annualized implied volatility, multiplied by the square root of the number of days divided by 365. That tells us what the expected trading range is over a certain period of time. So if we know that we have a $50 stock, and we know that it has a 20% implied volatility, what that means is that there is a 68% chance that the stock will be between $60 and $40, exactly 1 year from today. Now, the problem with this is that what are the chances that we need to know what the 68% trading range is over the next year? Chances are we're not trading an option that expires in exactly 1 year. Chances are we are trading an option that maybe expires just 3 weeks from today or 5 weeks from today. And maybe we don't care what the 1 standard deviation move is. Maybe we care about what the 2 standard deviation move or the 1.5 standard deviation. So this is really where we want to merge the insights that volatility provides us with with the actual things that a trader needs to select their strike prices. And that's really where we turn into using the implied volatility and delta calculations that are actually calculated off of implied volatility. So we can use delta, and just to backtrack a little, the delta here, which is the column right here, on both the calls and put sides, are calculated off of the implied volatility that we back out from each option, or back out from the extrinsic value of each option. And what this allows us to do is to not only calculate the one standard deviation, it allows us to calculate the probabilities of every single strike price. So if the stock price is somewhere in between $60 and $61 currently, what if I just want to know what is the probability of the 56 strike being in the money or out of the money, or the 64 strike being in or out of the money? That's what delta allows us to do. And as you can see, the deepest in the money call options will have the highest delta. The highest out of the money options deltas will have the lowest deltas, because if the stock price is currently at $60, what are the chances that the stock will be above $46? What are the chances that the stock will be above 46 by October 16th? The answer is basically 99.4%, because if the stock's trading at 61, the chance of it being above 46 is pretty damn high. As you can see, delta tells us that's roughly about a 99% chance of that happening. Now, what are the chances the stock stays above 50? Delta tells us there's a 95% chance of that. What are the chances that stays above 54 by the October 16th? 93. And as we get closer to the current price, as you can see, the probability starts to tumble. And if you start to pick strike prices above the current price, now as you can see, what are the chances of the stock being above 64 by the October expiration date? 13%. What are the chances the stock will be above 66? 9%. What are the chances of the stock being above 68? 1.6% chance. This is all being calculated off of the implied volatility. The implied volatility gives us a sense for what is the future expected volatility, and that helps us calculate what is the probability of a stock being at a certain price sometime in the future. And this is very useful for you to select your strike prices. Why is this useful? Let's say you want to sell a cover call on this particular stock. You know nothing about the stock, you have no directional view on the stock, but delta alone can give you a better understanding as to what strike price should you sell, because I know nothing about the stock, but the market already has an implied volatility for the stock. So I can know that if I want to sell cover calls on this stock, and I don't even know what the stock is, I don't know anything about the fundamentals, I don't know anything about the technicals, I don't know anything about the directional view of this stock, but I can tell you as a cover call seller, I would probably pick strike prices somewhere between 63 and 64, because the market is already telling me that if I pick the $64 strike, there's only about a 13% chance that the stock will be above 64, where I will lose my stock and have my stock called away. If I sold the 63 strike, I increase my probability up to about 21% chance of that stock being called away. So as you start to think about your option strategies, whether you're buying or selling, we always talk about best practices for buying. You want to buy something with a slightly higher probability, like something like this, where I buy a $60 call option that has a 60% chance that that call will expire worthless. And when we're selling options, we want to sell something maybe in the 13 to 20% range, so then I can know how to build the right debit spreads, credit spreads. All different types of spreads are based on this fundamental thesis of understanding how implied volatility is used to calculate probabilities, because the probabilities is an extremely useful tool in helping you select your strike prices. It doesn't matter whether you're selling cover calls, whether you're trading spreads, you're all selecting your strike prices based on these probabilities, and these probabilities are all backed out using the implied volatility. So if the implied volatility of a stock is higher, so let's say in this particular case, most of the implied volatilities here are in the 15, 16, 18 range or so, but they're all in that rough range. But what if you have a stock that's trading at, let's say, instead of 15 to 16% vol, what if it's trading at 60% vol? What's going to happen is naturally this $64 strike, instead of having a 13% chance of expiring, this strike might actually have something like a 35% probability of expiring worthless, because this stock is much more volatile. So there's a much higher chance that the stock will be above that $64 level. So deltas are already naturally accounting for how volatile a stock is. And this is an extremely important, I would say, very important theory to understand, because that's how we select strike prices. We select strike prices based on volatility. The more volatile a stock is, the further away we want to sell those call options. And the less volatile the stock is, the closer we want to sell those call options. But how do we know whether, an option is cheap or expensive, or what the future expected volatility is? That all comes down to implied volatility. So implied volatility is really what drives almost all of the decision-making process for a trader. It drives the decision as to whether it makes sense to be buying volatility or selling volatility. It drives the decision to select the appropriate expiration dates depending on what market events are coming up. It also drives which strike prices we choose, because the more volatile a stock is, the further away we'll pick those strike prices. The less volatile a stock is, the closer we'll pick those strike prices. But these things are all interconnected. But it is also at the same time a bit of a complicated subject, just because there are so many things that go into it. It requires a fundamental understanding of intrinsic versus extrinsic value to kind of understand the concept of implied volatility. But once you do, it is rooted in the foundation of all the things that we do here at OptionsPlay, is all driven off of this implied volatility metric, which is why it's important to get that implied volatility calculation correct to give you a better understanding as to how that flows into the rest of your work stream. So with that covers what I wanted to share with you. Just a quick review here. It's important to understand the difference between historical versus implied volatility. Implied volatility is really the one that you want to focus your attention on learning and making sure you have a better understanding. Whenever we talk about an option is built on two parts: an intrinsic versus extrinsic value. The intrinsic value will never change unless the stock price changes. The extrinsic value will change even if the stock price doesn't change, as long as the market expects the future volatility to either be more volatile or less volatile. So it's important to understand that extrinsic value component, because the extrinsic value component is actually what's being used to calculate implied volatility. Now, once you calculate implied volatility, it's generally used to give you a better sense for whether something is cheap or expensive. But in order to really understand whether something's cheap or expensive, it's important to understand the different implied volatilities. Looking at the individual strike prices, not very helpful in giving you a better sense for whether it's cheap or expensive. When you look at the summary of the entire chain, so for example, the average 30-day volatility, similar to what the VIX does for the S&P 500, that many times can give you a better understanding whether an option or a symbol is relatively cheap or expensive from an options perspective. But it's also important to understand that the limitations of that, because most of these indicators are calculated using front month 30-day options. If you're trading a back month 6-month option or a 1-year option, those front month metrics may not be very relevant. So it's important that you understand how they're calculated and know that when you're trading short dated options, they're useful. But when you're trading long dated options, you may want to have an external source to calculate the 60-day or 90-day or 180-day implied volatility averages. Look at how that's trading compared to its 1-year history to give you a better understanding as to what you are trading and whether that is cheap or expensive. And all of this flows back into how do you select your symbols? Because generally speaking, options traders will want to look at symbols that have very high implied volatility for option selling strategies. They want to search for low implied volatility stocks to buy options. How do you select your expiration dates? You want to look at the expiration date cycles and see where is there an expiration that has particularly higher volatility versus another one that has particularly low volatility. And you generally want to optimize around buying low volatility, selling high volatility. And lastly, strike prices. it really comes down to the fact that deltas are derived from implied volatility. So the more volatile something is, the further those strike prices will be for the same delta. The less volatile a stock is, the closer those strike prices will be to the current price, and that influences which strike prices you choose depending on whether you're looking to buy or sell. So that covers what I wanted to share with you here today. Like I said, this is a difficult topic to grasp. It's not the easiest topic to grasp, and it does require most investors who are watching this to have a basic understanding of options and perhaps some experience trading options. So the terminology like cheap or expensive, implied volatility, you know, makes sense to you, or you've heard of them before, but for this session to make more sense. If you've never heard of these terms before, I do recommend 4 weeks ago, we recorded an introduction to volatility segment. I recommend that you watch that first before you come back and rewatch this for your better understanding of volatility. So with that, thank you so much for taking the time out here this afternoon. I really hope that this was useful in helping you help give you a better understanding of volatility. So at this point, what I'll do is I'll open this up for Q&A. There is a chat window and there is a Q&A window. If you don't mind, please put your questions into the Q&A window and I will answer your questions out of that. George is saying, from this chart, how do you determine in the money scenarios? So call options that are above the current price are, so it really just comes down to whether you're talking about an option that's a call or a put. And this is something that just, you know, is nothing other than from experience from trading. So this is the at the money call or put. As you can see, the gray shading, that's how I know that these are in the money calls, and these are in the money puts in the gray shading, and anything that's white is out of the money. So these are in the money, these are out of the money. This is something that just is the absolute basics of options trading that you need to learn as to what constitutes as in the money, what constitutes as out of the money. But at the end of the day, these are just, you know, doesn't matter, you know, whether you know that or not, to be perfectly honest, as long as you know which options you're trading. It doesn't really matter whether you're trading an in the money or out of the money option per se. It's just that generally speaking, you want to know your best practices. Tony's asking, hey, Tony, I thought delta is sensitivity to price, not probability of getting to the strike price. Tony, it's both. Delta tells you the sensitivity of the price to the underlying stock. It also at the same time tells you the probability of the stock being above that strike price. I'm sorry, being in the money at expiration. Does delta take into account of the upcoming earnings date? It does. So delta is, because delta takes into account implied volatility and implied volatility takes into account the upcoming earnings date, then delta naturally also accounts for the upcoming earnings expiration. So what you're going to see is that, for example, in the ones that I showed you here before, I'm willing to bet that this November option has this, whatever stock this is, and I don't even know what stock this is, I'm willing to bet that the there's an earnings report sometime between October 16th and November 20th. That's why the November options trade at a substantially higher volatility than the October options. So this automatically accounts for that, meaning the higher implied volatility for the options that have earnings, and that will also naturally affect delta calculations as well. Frank is saying VIX is based on the S&P 500. Is it good for the Canadian market? Generally speaking, it is not. I was just using VIX as an example because that's one that everyone is familiar with. There also is a TSX 60 VIX indicator. However, I don't believe that that is still being calculated here at the moment. So I was just using VIX as an example of a famous summary volatility indicator to give you a better sense for what I meant. Jan is saying, I often see options showing 120, 180, or 200%, 250% implied volatility or anywhere in between. How do you explain this? That just means that that stock moves a whole lot. You know, so when you have implied volatilities that are that high, that means this stock moves a whole lot over the next year. Now, that means that there's a relatively high probability the stock can be double or close to zero, 1 year from today. That's really what the high IV is telling you. Frank is asking, what is 13-week HV rank in the option chain on Interactive Brokers platform? That means that it's taking the 13 weeks. So I'll be perfectly honest. This is really where each firm, each platform has its own definitions. It's hard to know exactly what 13-week implied HV rank is, but what it does is it basically saying it's taking the historical volatility and it's plotting the historical volatility on a chart that looks like this. And the 13-week part is the part that I'm not sure of. Is it looking back 13 weeks or is it 13 weeks of data? You're going to have to ask the Interactive Brokers the answer to that question, because it could be looking at 13 weeks worth of historical volatility, but looking back a full year, or it could be looking back only 13 weeks, but the period of historical volatility looking at is maybe 20 or 30 days. So you're going to need a little bit of clarification from Interactive Brokers on that front. Barry saying, hi, Tony, why not buy a stock when it pulls back to support and sell the at-the-money call simply to take profit and move on? Barry, if you're okay with just keeping the yield of the at-the-money call option, so here's the reason that I wouldn't do that, right? Because what you're doing is you're taking the risk of that stock going down to zero in exchange for just the at-the-money call premium. Is that a risk to reward ratio that makes sense for you in the long run? I generally find that, based on our back testing, that doesn't work, because when the stocks move sideways, you keep the maybe 1% of that at the money call option. That makes sense. But what if the stock drops 10%? Now you're down 10% in exchange for just a 1% premium. You're saying that, yes, if the stock pulls back to support, what if the stock breaks below that support? In the long run, we generally tend to find that strategy will underperform, because you're giving yourself no upside in exchange for all the risk of the stock going down to zero or the stock dropping significantly. That's not a risk to reward ratio that I like to take. It's a little different than when you're selling a put option, because it's a very similar risk profile, but you're selling a put option that's out of the money, so you have a higher probability of profit. You have the same risk to reward ratio, but you have a higher probability of profit, and that makes up for some of that. But when you're buying at the money call option, the risk to reward ratio, in my opinion, in the long run, doesn't quite work out. Can this material be reviewed later? Yes, we record these and we send the slides out for everyone. Also, what is the IV percentile also on IB's platform? So the IV percent, again, Frank, you're gonna have to be a little bit more specific. If it says IV percentile or IV rank, those are the two different formulas that you can use. But if you're just talking about IV, then that's just talking about these individual implied volatilities of each individual strike price. That's what IV percentile, IV percent usually means. Does Delta take into account the upcoming earnings date? I think I've already answered that, Peter. Bob is saying, can we speak about volatility in the sector sense, such as financials, tech? Yeah, absolutely. Every single sector has an ETF, so you can always look at the implied volatility of that ETF to give you a better sense for the implied volatility of that specific sector. Hi, Tony. If you're buying multiple calls and put options with the same expiration date, does your 2% of portfolio rule cover each option position or the total option positions? So Mohammed, this is referring to a different webinar. You're obviously asking the question from a different webinar. We have a 2% rule. I suggest that you go back to that webinar, because I talk specifically about if you have multiple positions on one expiration date, how do you handle that? How do you calculate it? If you have calls and puts, you can certainly assign different, 2% to each individual call or put, but understand that you are adding more risk to your portfolio because they all expire on the same day. Chris is saying, I've written puts on stocks that I don't mind owning. If the vol is low or cheap, what other strategies would you recommend if I'm willing to own the stock. So Chris, it's not that when vol is low that there's a better strategy to trade. It just tells you that when vol is low, you're going to collect a smaller premium to sell that put option, which means that you're going to get a lower discount. And the question is just whether or not that cheap or expensiveness, or that the premium that you collect on that put option is enough for you to take on the risk of potentially owning that stock. When vol is cheap, there's nothing that you can do other than maybe buying a call option. If vol is really, really cheap, maybe the best thing to do instead of selling put options is to buy a call option, because that gives you that means that you're buying the extrinsic value of that call option for a very small piece, for a relatively cheaper price. So as things get really cheap, you want to then buy options versus sell options. When things are more expensive, that's when you want to lean towards selling puts rather than buying calls. Jonathan is asking, implied volatility plus time value equals extrinsic value. No, extrinsic value is simply just the value of the call option. So whatever the value of an option is in the open market. So when you bring up your option chain, your chain will tell you what the price of the option is. You subtract the extrinsic value, which is the difference between the current stock price and the strike price, in this particular case, which is $5. So the extrinsic value is just the remaining amount of the call option once you subtract the intrinsic value from the option. Do you know of websites that show IV ranking and percentiles of stocks in the Canadian US markets? So Peter, on the US side, we calculate IV rank and IV rank for our US customers. We are currently in the process of collecting the data that's required to calculate IV rank for Canada. We don't have that just yet. It's because we need that 1-year price history of all these different options in order to know whether the current option is cheap or expensive. We're in the process of gathering that data. So we hope to have that live soon. So you'll say US elections increases implied volatility. So generally speaking, you will see implied volatility spike going into an election because the markets do see the president as a mover of the markets. So when there's uncertainty as to what the outcome is going to be, implied volatility is naturally going to get elevated. I would argue that it already has been elevated ever since the end of August, beginning of September, where we've seen some more volatility. We've seen this volatility start to raise. We actually saw volatility pick up before the end of August, actually. As markets were making new all-time highs, volatility was actually also making new relative highs. So there was already this sense of unease or its uncertainty in the markets even before the recent volatility we've seen over the past 3 weeks. Barry, you're very welcome. Any other questions on volatility, implied volatility, volatility on the options that you're trading? Jan is saying extrinsic value is affected only by IV, Vega, and time. Is my understanding correct? So Jan, I think of it the other way around. IV is affected by extrinsic value. So extrinsic value is actually, so think about it. At the end of the day, what you're trading are calls and puts, right? So for example, if let's say you think that let's say you have a stock that's trading at $25 and the $20 call option is currently trading at $7. And you think this stock is going to go to, I don't know, let's say you think the stock is going to go to 100. You are convinced, you have a strong conviction that this stock is going to take a big move to the upside. Guess what? For you, this call option is really, really cheap because you think that this call option should really be worth $30, $40 because you think the stock can go to 100. This is an example of the market mispricing the options where the options are too cheap. And guess what? You and maybe other market participants will bid up the price of this call option. You'll pay $7, someone else will pay $7.50, someone will pay $8, and people will keep paying more and more monies for this call option until they believe that the value of this call option is fairly priced for the expected move that they think the stock is going to move in. So what you're really doing is you're bidding up the extrinsic value of that call option by saying that I think this option is worth more. And when you do that, and when I say you, I don't mean you specifically. When I say you, I mean the market. If everyone in the market thinks that this stock is going to rally, they're going to keep paying more and more money for this call option until maybe the extrinsic value of this call option, instead of being $2, maybe it's now $15. And when the extrinsic value of this option gets to $15, guess what? That's going to increase the implied volatility, because the implied volatility is calculated off of this one extrinsic value. So when the extrinsic value is very high, then the implied volatility is very high. So you have the right idea. It's just that it's the other way around. It's the extrinsic value that is affecting the implied volatility. And implied volatility is just a simplified way of expressing whether the extrinsic value of an option in an annualized standardized form. Because, you know, here, this is a $25 stock with the $2 extrinsic value. But what if this is a $36 stock with a $4 extrinsic value? Is that cheap or expensive? You know, that's why we created the implied volatility, because I just have one number that I can compare. I can compare 15% implied vol for one stock versus, let's say, 20% implied vol for another stock. And I will know that the 20% implied vol stock has a higher implied volatility than the 15. I don't have to look at the stock price. I don't have to look at the extrinsic value. That's why we created implied volatility. So we have one indicator to look at to say, apples to apples, is this stock more volatile than that stock? So I hope that that was a better understanding and gave you a deeper understanding as to how extrinsic value and implied volatility are linked together. You're very welcome. Any other questions? Kaz, you're very welcome. Thank you so much for joining us this afternoon. Kunal is saying IV should be measured against its peers in the same index. Not necessarily, because you could have peers that trade at fairly different volatilities. So, you know, for example, if you think about the mining, or let's talk either the mining sector or the energy sector. You obviously have some energy stocks that are far more volatile than others, even though they're in the same sector. So you don't necessarily want to compare IVs from one stock to the next, unless you're comparing IV rank. That is something that you can compare one stock to the other. If you want to compare IVs, you want to compare against its own history for that. You don't want to compare it against similar stocks unless you know that two stocks have very similar implied volatilities. Is buying a debit spread when an IV is low and selling credit spreads when an IV is high is a good strategy? So Sebastian, like I said, it depends on how you're measuring IV. Like I said, there are lots of different IVs. So if you're looking at the IVs of individual strike prices, that's not useful. If you're looking at summary implied volatility, that's a little bit more useful. If you look at implied volatility rank and percentiles, that's even a little bit more useful. But I still want to refrain from just saying buy debit spreads when IV is low and sell credit spreads when IV is high. The reason I say that is because just because IV is high doesn't mean that it can't continue to be high. If we look at this chart here, right? So if we look at this date right here, when IV spiked from 15 to 40, on that day, guess what? The implied volatility rank on that stock was 100, because that's the highest that implied volatility has ever been in that past year. But does that mean that volatility is going to go lower? No. Just because it's high doesn't mean that it can't go any higher. And just because volatility is low doesn't mean that it can't continue to be low for a very long time. Those are two very different things. So as a general rule of thumb, selling vol when it's high and buying vol when it's low is generally good practice. But I just want to warn investors, just because you have high volatility does not mean that volatility can't go higher. And just because volatility is low doesn't mean that it can't continue to go lower. So I just want to make sure that everyone understands that when we say that, take that with a very large grain of salt. Don't use that as your overarching strategy of saying vol is low, I have to buy, or vol is high, I must sell. There's nothing that says that when vol is high that it can't get much higher. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. Like I said, this is a more advanced topic. It takes a bit of time to ingest and better understand how it's being used. And there are lots of other great resources out on YouTube if you want to learn more about implied volatility. I do recommend it because it's not something that you necessarily just learn all at once in a 145-minute webinar. It takes time to take what you've learned here today, start playing around with it as you start to select your expiration dates, strike prices, strategies. And then many times you have to come back and learn more before you fully have this complete view of volatility and how it works for your portfolio. So with that, thank you so much. I hope you guys have a great afternoon. We will send out both the recording and the slides once we finish processing that here today. Thank you so much and have a great trading day.